So, it's tax time again. Now, I don't want to be one of those annoying people that says, there's Easter eggs in Coles and it's only February, but it does feel like tax time has come along pretty quick. Now, I want to share some quick tips on what you need to do as a property investor in the lead up to June 30 to make sure you're getting the best possible results. Now, down to business. I'm a tax depreciation guy, so we're going to talk about that. If you've purchased an investment property in the last little while and haven't had a depreciation schedule prepared, please email someone such as myself. Since the depreciation changes came out in May 2017, it's become a lot harder to analyse potential depreciation deductions on an investment property, so you need to speak to an expert. In the vast majority of cases, we're still finding depreciation deductions that are worthwhile in the property. Now, if you have a depreciation schedule, they last for 40 years from the date of it being prepared for most quantity surveyors, so it should be current and it should show you all the deductions you're entitled to claim this financial year, with one exception. That is anything that you've done to the property since that depreciation schedule was prepared. Now, you'll need to find the item, so what was done, the date that it was purchased or installed, and what the cost was, and you can give that to your accountant to depreciate alongside your depreciation schedule or write off. There's no estimating required when you have the invoice, so you don't need a quantity surveyor, but most quantity surveyors will update your depreciation schedule free of charge if it's one or two assets. If it's a major renovation, you may need to get a new depreciation schedule prepared on your investment property. Now, let's talk about things that you might have done to the property. One thing the ATO have announced that they'll be clamping down on is incorrectly claimed repairs and maintenance allowances. So let's look at repairs and maintenance versus, say, an improvement. If you throw out an old hot water system and you put a brand new one in, that's not repairs and maintenance. That's not an immediate deduction. That is actually a depreciable item. If you've got, say, a deck and you're replacing a few sticks of timber to restore the function of that deck, then that's repairs and maintenance. So repairs and maintenance are fantastic because they're an immediate deduction. If you spend $5,000 on repairs and maintenance in your investment property, then you get a $5,000 tax deduction in that financial year. Whereas, say, if it's a capital improvement, it might take 40 years to get the deduction back. It'd be 2.5% of the value for 40 years. So just because it's advantageous to be repairs and maintenance doesn't mean that you qualify for that expense to be repairs and maintenance. So I've shared a blog to help you to determine whether it is repairs and maintenance or whether it is an improvement that you need to depreciate. Of course, you'll need to collect any other expenses that relate to your work, so it's great to give that to your accountant in a way that they can work with, whether it be a nice Excel sheet or something like that. Item, date and cost are always the best way to put that together. And the ATO is going to be doing a lot of benchmarking this year, such as they have always done, but they've been allocated some extra resources. So if you're a teacher or a doctor or a plumber, they know the rough range of work-related expenses that people are claiming in that profession. So it's important to be able to justify those and have the documentary evidence if you get one of those please explain letters. So that's just a couple of tips on things that you can look at in the lead up to June 30. I hope it's a very good visit to your accountant this year and you get some juicy deductions.